How's it going today, guys? So today we're going to be talking about my top 10 core rules as far as investing goes for beginners. Now before I get into this video, guys, I just want to remind you I have a free course out on how to find a great investment. I'm adding different lectures to that every single week, and we have a number of different lectures in there right now. If you guys want to join, it's completely free and you get access to the entire course. The link is in the description below, and I will also leave a pinned comment. But let's go ahead and talk about my first investing rule, which is to avoid following the herd. This is probably the most important rule out there, because what happens when you follow the herd is you're following what everyone else out there is doing. You hear about your friends getting into a particular stock, or they're getting into a particular cryptocurrency. And it's not about investing in the stock market or cryptocurrencies or real estate. It doesn't matter what you're investing in, guys. If you're following the herd, you are going to get into trouble, because that is when bubbles form. That is when many people are moving into a particular asset and the price just goes crazy. It gets way out of whack with the intrinsic value of that asset. And I would recommend that you guys avoid following the herd. The reason people do this is because they don't want to make decisions on their own, and they don't want to work very hard, and they don't want to decide what to invest in. So they go, okay, what is everyone else buying? What is everyone else investing in? And it's just going to get you into trouble. So do not follow the herd. And if everyone else is getting into something, that's a good sign that it might be time for you to get out of it. Don't be following the herd and investing in these things that are forming a bubble-like appreciation at that point, because at some point that bubble will pop. So my number one rule, guys, is to avoid following the herd and make your own decisions when it comes to investing. Number two is to own your decisions. Guys, this is one of the most frustrating things for me here, and we're seeing this happen a lot now with these YouTubers that were suggesting people invest in BitConnect. Now, I really didn't talk about BitConnect. A lot of people did. They talked about how this was clearly a scam of some kind or a scheme. And, that's not what I'm talking about in this video, guys. But all I'm trying to say is people invested a lot of money into BitConnect. Obviously, it blew up. And now everyone is criticizing these YouTubers for pushing this platform. Now, do I think that they should have been making the videos they were and showing their returns and showing their wallets? That probably wasn't the best idea, because it gave people unrealistic expectations. But at the end of the day, nobody twisted your arm and told you to go put money into BitConnect. So what this comes down to, guys, is you need to own your decisions, okay? If you decide to invest in something, it's not because some stock market guru told you to do that. It's not because some YouTuber or somebody you know told you to invest in it. You, at the end of the day, click the button on your computer or hit the button or hit it on your phone, whatever you're using. You made that decision. You decided to buy that or sell that thing, and that's your decision, guys. Don't blame other people if you make mistakes. Say, you know what? I made a mistake and I'm going to learn from it, but do not play the blame game where you're going to blame other people for the decision that you ultimately made. Number three seems very simple, but so few people actually follow this rule. It is understand what you are investing in. So many people go out there and invest in very complicated investments or complicated companies. Maybe they're out there buying biotech or pharmaceutical stocks when they have no basic understanding of that business. You need to invest in a business that you fully understand, and the best test of this, we talk about this in my free course, is what I call the elevator pitch. I actually learned this from a friend of mine. It's a very good way to explain this, guys. You want to be able to give someone a 30-second elevator pitch on the company you're investing in and be able to explain the entire business in 30 seconds, maybe 1 minute tops. If you're not able to do that, you don't fully understand that company and you shouldn't be investing in them. You need to understand what it is you're investing in, otherwise you have no idea what to expect. And if you don't understand that business, how would you know if you're investing in a good business or a bad business? You wouldn't go out there and start a restaurant if you had no experience with the restaurant industry, but you will see people investing in things like that, investing in pharmaceutical, biotech, mining companies, or whatever, when they have no experience with that business. It's like going out there and starting this business that you know nothing about. So do not invest in something you don't understand, and just simply understand what it is you are investing in. That is a very important rule to follow, guys. Number four is to invest with a strategy. So many people go out there and just start buying stocks or bonds or whatever left and right. They're buying cryptocurrencies, who knows what they're buying, but they're just buying things for the sake of buying. They're investing because they want to invest. Now, is that a bad idea? Not at all, because I would always rather see people investing in something rather than spending that money or just sitting on it in cash. So hopefully, you're going to be making a bit of a return and, outpacing inflation. But so few people actually have a strategy when it comes to investing, and it blows my mind how people have no plan or no idea of what they're trying to accomplish by investing in this particular asset. Are you looking to preserve your wealth? Are you looking to grow your wealth over time? Are you looking to earn dividends over time? Are you looking to capitalize on growing companies? A lot of people invest in things. They have no idea what type of investment this is. And it's like building a house without a blueprint, guys. Would you go out there and buy a bunch of 2x4s and nails and screws and try to build a house from scratch? Absolutely not. You would have a blueprint or a building plan, and you need the same exact thing when it comes to investing. You need a plan for your investments, and that's going to be your investing strategy. Number 5 is very simple too. It seems like common sense, but time and time again, from the people I've talked to, I can tell that this is not something people are following, but you need to stick to your strategy. Once you decide on a strategy, once you decide, okay, I'm going to be a long-term value investor, or I want to invest in growth stocks of growing technology companies, whatever your strategy is, stick to that strategy. It doesn't matter what everyone else out there is doing. It doesn't matter if your neighbor is having a better return than you are. If you decided that was your strategy, then you better stick to that strategy. You're not going to dabble in different things and buy a little bit of this and a little bit of that and say, you know what, maybe I'll be a growth investor, but oh, you know what, I think I want to also day trade on the side and, maybe I'm going to throw a couple bucks in this and that. I'm not saying you guys shouldn't do that. A strategy could involve growth and value investments in things like bonds or gold or real estate or even cryptocurrencies. All I'm saying is develop that strategy before you start investing, and once you have that strategy, stick to that strategy. And maybe if it's not working, you'll reevaluate and develop a new strategy, but don't start just investing in random things and breaking away from your core strategy, especially if it's working. If you're a long-term value investor and you're making good returns and all of a sudden you hear people are possibly making better returns than something else, why would you start doing that? Why would you fix something that isn't broken? If you're already making consistent returns from the market, then don't mess with that strategy. Just follow that strategy. But so many people get dazzled by these new opportunities, and maybe this is what happened with BitConnect, as we mentioned earlier. People were making returns with their money, but they said, you know what, this looks like a better opportunity. Why don't I go do that? And that's where people run into trouble, is when you break away from your core investing strategy. Number 6 is to leave your emotions elsewhere. A lot of people make the mistake of making emotional decisions when it comes to investing in anything out there. I'm not saying it's the stock market or cryptos or real estate, whatever it is. Investments have nothing to do with your emotions, and a lot of people involve their emotions with their investments. Particularly, they buy things out of excitement and then they sell them out of fear. If you're going to be investing, guys, again, this ties in with having a strategy. You're going to know what it is you're buying. You're going to know when you're going to buy it and have an idea of when you're looking to sell it. So your emotions should not be involved with that at all. But so many people get their emotions involved. They track the stocks too frequently. They're watching the prices go up and down, and they're going to make some bad decision based on their emotions. And I just want to ask you guys, have you ever once in your life made a quick decision or a jump decision and been happy about that in the long term? I know this is a mistake that I made early on, in my investing career. When I had started investing, I would buy a stock, when I would see it go down 5 or 10%, and I would get all nervous and I'd get emotional. I would become fearful, and then I would sell that stock. And then a week or two later, it would recover or even go higher. And I'm like, what am I doing selling this thing for no reason? If you make the decision to invest in something, especially long term, you want to own your decisions. You want to stick to your decisions and follow that strategy. And leave your emotions elsewhere. Write in your diary or, watch soap operas. Use your emotions for something else in life. Don't involve them with investing. Number 7 is very simple again, guys, but so few people follow this. The core rule to investing, this is straight out of the mouth of Warren Buffett, is to buy low and sell high. Now, he says this in, different phrases or terminology out there, whether it's be greedy when others are fearful and fearful when others are greedy. But what he's saying by this is to buy low and sell high. So when something is on sale, that's the time to buy it. When something becomes overvalued, that is when you sell it. But so many people look at a particular stock or particular asset and they see the price climbing higher and higher and higher, and they say, you know what? FOMO has triggered, the fear of missing out. I better buy some of that because it's going nowhere but up. But what they don't realize is this is the herd. This is the herd moving into a particular asset, and they're driving that price higher and higher, and that investment is becoming more and more speculative, less based on current value and more so based on future expectations. Notice the word there, expectations. It doesn't mean it's going to happen, and any one thing could trigger that asset to go into a sell-off, whether it's a particular stock or cryptocurrency, whatever it may be. Maybe you're investing in a company that's involved with a new emerging technology and everyone's getting really excited about it today, but then there's a snag with the business going forward, and all of a sudden you're going to see that house of cards fall because it was trading on a speculative basis and pricing in all of that future growth today. So you want to buy low and sell high. You're not going to buy things when they're way up. You're going to buy things when they are on sale and sell them when they become overvalued. You want to buy from the pessimists and sell to the optimists, guys. I'm tying in words from Benjamin Graham here and Warren Buffett, some of the greatest investors of our time. Number 8 is something people do not do. You need to diversify. So many people out there go all in on one particular investment or on one particular industry or sector, and maybe that's going to work for a little while. Maybe you're investing heavily in the tech sector and you've been having great returns. Maybe that's working for you now, but I can guarantee that at some point, that sector is going to be hit hard. The technology sector is going to take a dip. And if you're not diversified into other different sectors and industries, your portfolio is going to take a massive hit and you're going to be chopped off at the knees. You want to make sure you're diversified into different parts of the market, whether it be, in the United States or global markets, whether it be different industries or sectors, defensive versus cyclical industries. And you also want to diversify out of stocks as well. Maybe you want to hold bonds or cryptocurrencies or real estate or gold or different things that are going to hopefully preserve value or appreciate in value. But the number one rule here, guys, with this, and I know these are all very important rules. I know you guys are probably seeing this, but this is just the mistakes I see people make day in and day out. I get comments from people saying, I went all in on this stock, I went all in on this investment, and it blew up in my face. It's like, why didn't you diversify? So learn about some basic rules of diversification, guys, and don't put all of your eggs in one basket. Number 9 is to plan your decisions. You're not going to wake up and decide, okay, I'm just going to go buy a stock today, okay? You're going to plan that out. You're going to study that company, learn fundamental stock analysis, and you're going to decide when the opportunity arises to enter that position. When that stock goes on sale, you're going to take a bite of it. You're not going to just jump in at some random point in time and buy any asset out there. And so many people do not plan their decisions when it comes to investing because of the fact that they are trading with an emotional strategy. They're getting their emotions involved and they're getting excited and they're buying something on impulse, okay? You're going to plan your decisions. You're going to study a company. You're going to find the optimal time to buy, and then you're going to get in. And then you're going to have a point in time when you say, you know what, I think this is when I'm going to sell it. But again, you're going to plan this out. You're not just going to randomly buy or sell a stock in the middle of the trading day just because of some company announcement or whatever. You're going to plan your decisions. And number 10, guys, finally, remain active or passive with the market. Active investors are out there buying individual stocks, and they're spending more time learning about investments and studying companies. Passive investors, on the other hand, are buying things like index funds and just holding the broad market. Now, I do believe, and I do think that you as an investor, even if you're an active investor, you should hold a low-fee index fund no matter what. That is the core of your portfolio. But if you're somebody out there who just wants to be a passive investor and you just want to hold index funds, then just hold index funds. Again, that is your strategy. Your strategy is you are a passive investor. Why would you mess with the strategy if it's working? You see a lot of people that are having success with, just investing in the whole market, and then all of a sudden they hear about some hot stock or something to invest in and they go, you know what? I think I'm going to buy that. If you decide that you want to be a passive investor, then be a passive investor. If you want to be active with your investments, then be active with your investments. But don't go back and forth. Don't be active with your investments for a while and keeping track of your stocks and earnings reports and, doing your due diligence and research, and then all of a sudden say, you know what, I'm bored. I'm not going to keep track of this stuff anymore, and then just leave it. You want to make a decision of whether or not you want to be active or passive with your investments, and then stick to that decision. Anyways, guys, that is all I got for this video. These are my top 10 core investing rules for beginners. I highly recommend you guys write these down somewhere or revisit this video once in a while to remind yourself of these. These are rules I follow myself, and I highly recommend you follow them as well. Thank you for taking the time to watch this video. If you enjoyed it, please drop a like. If you're new to my channel, please consider subscribing to be notified of any future uploads, and I hope you have a great rest of your day. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.